You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Tritax Big Box, ITV, Rolls-Royce, Ibstock, London Stock Exchange Group, and our US company of the week is C Limited. Sam, shall I kick us off with Tritax?
Yes, I think it's been a couple of years since we last covered Tritax.
It has, and I think it's become actually quite a lot more appealing. They had their full year results out, and so for anyone who doesn't know, Tritax Big Box is a real estate investment trust. It's one of the UK's leading real estate investment trusts specialising in logistical properties, and they also have made a little bit of a move into data centres more recently. Anyway, full year results out were pretty good. They increased their net rental income by 24.3% to £276 million, up from £221 million a year earlier, with strong leasing activities and asset acquisitions. Operating profit grew by 37.3% to £265.3 million, driven by more effective cost management and the revenue growth. Adjusted earnings per share rose by 15% to 8.9 a share, with increasing profitability. Dividends per share also increased by nearly 5% to 7.6 a share, and total accounting return achieved 9%, which is the highest since 2021, with their strong overall performance. Specifically, in terms of some of their operational achievements, contracted annual rent increased by 39.1% to £313.5 million. And this was attributed to, with strategic acquisitions, improved asset management and development activities. Portfolio increased to £4.8 billion with significant expansion of the estate, and like-for-like portfolio estimated rental value growth came in at 5.4% for the full year 24, reflecting favourable supply and demand dynamics in the logistical real estate market. The data centre development, they acquired a 74-acre site near Heathrow Airport to develop a major data centre, marking a strategic shift towards data infrastructure projects. And this is expected to yield a 9.3% return, higher than their traditional logistics centres. There was the merger with the UK Commercial Property REIT, which was announced in February 24, aiming to create a combined entity valued at around £4 billion, and the merger received approval earlier last year, and it's now going to be put in the FTSE 100. In terms of valuation, Tritax has a market cap of £3.6 billion and trades at a 23% discount to the estimated net asset value, and it trades at just 7.3 times earnings, with a dividend yield of nearly 5.5%. I thought these results were really good. I think when we looked at it before, it was on the back of the COVID surge in online commerce. I think it was probably quite a bit more than we would expect for a real estate investment trust in terms of valuation previously, and that has certainly put me off. I think it's now much, much more attractive from a valuation perspective. And I think the data center side of things is quite appealing too, as well as that traditional big box logistical operation that they run so effectively. I think also the merger, it looks stronger for the group. They're certainly a bigger player than they were, and I think sort of more on par to compete with peers like Segro in the market. And I think from a valuation perspective, quite a bit under that too. And it's got a decent dividend yield. Of course, with these real estate investment trusts, they do have to pay out a certain or a fixed percentage. And I think some of the sort of uncertainty in the e-commerce market with the cost of living, I think that has been reflected in the valuation. But now, for me at least, it looks much, much more fairly valued. And I would probably put it on my watch list, I think. Sam, what are your thoughts of these full year results from Tritax?
I think the results are decent. I think there's nothing amazing in there just because most of it's because of the merger. I agree the merger is a sensible one. So it makes them the fourth largest REIT in the UK. And I think a lot of the properties kind of complement each other. I think it's interesting that it's now trading at such a discount to the net asset value, because it's not like a normal REIT where, I don't know, say they've got like an office block in a city centre and it's not entirely clear what the future for that building is. A lot of these buildings, it's like the big Amazon warehouses, for example. It's that kind of thing. And you'd think they're the types of buildings that would continue to do really well and go up in value. So I'm surprised the discount to the net asset value is that high. I think it was actually trading at a premium in COVID. And it, like you say, it did have a very nice run up then. My main issue, and I think it's partly probably because of the quality, but I think there's quite a few attractive REITs in the UK at the moment. So we covered PHP the other week, and you're getting nearly an 8% yield from them, basically backed by the government. There's a good chance we'll cover it next week, actually. But Supermarket Income REIT, they've just come out with their earnings. You're getting like nearly an 8% yield from them. I'd say Supermarket Income REIT is also very high quality in terms of the buildings and the values of them. So I think to be getting under 6% from Tritax, I think is a bit low. I guess you could counter it by saying, well, the discount to the net assets is also very low. And, you know, how much more of a discount do you want for such high quality buildings? But I just think for me, with it being under 6%, I'd probably take a look at Supermarket Income REIT or even Primary Health Properties before I looked at Tritax. So I'd probably want to see that yield another percentage or two higher, really. What do you think of the yield in comparison?
It is lower. I would accept that. I think one other point that might be worth making is on the data centers. I appreciate that's very much a growth industry. I suppose one concern more on the sort of the bear case for that is that energy costs are so high in the UK. You would wonder whether that would impact and limit sort of data center expansion. So how much of a growth industry that is with our current energy policy, and that we have some of the highest energy prices in the world, and particularly when you're looking at sort of electricity, I think that may hinder that in terms of that particular growth story. Whereas, you know, for example, going to the States where you have, or China where you have far lower energy costs, you'd wonder whether in something that's very international with data centers, whether you'd just be having the expansion over there where you have an abundance of cheap energy.
But then for the data centers, isn't there an element of if you need a data center, it kind of costs what it costs?
But would you, if it's a global market for data centers,
then if it's further away, doesn't that mean that the data doesn't get there? Well, it obviously does mean it doesn't get there as quick. I'm not that but if you need one in the UK for whatever reason, the next closest one, it's kind of got to be like wired under the channel, hasn't it? So
yeah, I mean, it's not something that I have great knowledge of, but it's something, a reason why we presumably don't have so many data centers in the UK. Otherwise, I would have thought that we would probably have quite a lot more, but that's just from a layperson's perspective.
So what I'm thinking of, like, say for example, you've got something in London where it's to do with financial markets, it needs to be as quick as possible. That's probably worth paying a premium for a UK one.
I would imagine so.
Whereas for most stuff, if it's like a fraction of a second slower and you can get it cheaper, it's probably not going to make a huge difference.
Yeah, that would be my impression. So limiting that expansion. But shall we move on to ITV then?
Yes. So ITV have come out with their full year results, and full year revenue fell 3% to 4.1 billion. As growth in total advertising revenue was offset by the expected decline in studios. Underlying cash profit, which is the earnings before interest, tax and amortization, rose 11% to 542 million, with cost cuts helping both the studios and media and entertainment divisions contribute positively. Free cash flow fell 10% to 325 million as the ramp-up of production activity following the US industrial action impacted cash generation. Net debt improved from 553 to 431 million at the year end, helped by the proceeds from the sale in its stake in BritBox International. So I think this is quite interesting because part of the, I guess, growth story or the bull case for ITV was this BritBox, which I don't think there was ever anyone really thinking it was going to go out and not Netflix off its perch, but at the same time, there's quite a few Americans, for example, that do like certain British channels like Doctor Who. I know that's BBC, but it was paired with BBC. But it had a 50% stake, which it sold to BBC for 255 million. And now they're just focusing on ITVX, which is basically just UK based. So they've kind of given up on global streaming. So the net debt's improved because they've paid off a chunk of that with the BritBox sale. ITV Studios revenue is expected to grow ahead of the market in 2025, with performance weighted to the second half. The group expects to deliver a further 30 million of cost cuts in the year. Final dividend has been announced, which takes the total dividend in line with last year. And the shares were up 4.2% following the announcement of the results. So it is an industry that's in structural decline, given the traditional broadcast advertising model is just going to be getting smaller and smaller as fewer and fewer people watch television. I think more and more people, especially as a population, as you've got more of like millennials and I guess Gen Z coming through, I think that proportion of people watching streaming over traditional TV is just going to get bigger and bigger. ITVX is actually now the UK's fastest growing streaming platform over the last 2 years, as streaming hours and monthly active users were both up double digits. And they targeted a 50% increase in digital revenues by 2026, and it looks like they're probably going to hit that. In terms of the valuation, the business trades at a forward P of 7.6, and that compares to a 10-year average of 9.7. The prospective yield for the next 12 months is 7.3%, and that compares to a 10-year average of 5.7%. And that yield is actually pretty well covered. It looks like it's only about 57% of earnings, I think. So don't think it's actually terrible valuation. In terms of the revenue for the past 5 years, that has gone up at about 10% per year on average, despite the drop in the most recent year. However, that is using a 5-year figure, which includes the COVID year as the starting point. So that's probably why. Yeah, so if you do it for 10 years, it dropped from 10% to 3.3. So I think it's because you've got that starting point with COVID that makes it look a lot better. Operating profit, that's declined on average 4% a year for the past 10 years. The operating profit margin's gotten worse over the past 10 years from 28 to 13%. So it is a business that it is in structural decline. If you go back and look at the results over 10 years, it is a business that's getting worse. That being said, I think this is a decent valuation. I think if you can get it under 8 times earnings, 7% yield, if it continues to grow revenue 3% a year and operating profit continues to decline under 5% a year, you're probably into sort of tobacco territory. The issue is that I don't think ITV is as addictive as cigarettes. It wouldn't be surprising if at some point that drop-off actually accelerated from the 5% a year that we're seeing at present. I know the ITV Studios is doing quite well in the last couple of years, but I think that's probably got quite limited runway, and I think that might help absorb some of the loss of the traditional revenue, but I don't think it's going to take it all. So I think at the valuation, I think it's cheap enough that you could make an argument for it and you could maybe do quite well. But I just think if I'm buying a business that is in structural decline, I probably just prefer it when the products are addictive. I think it gives you a bit more certainty. What about you, John?
Yeah, it's not one for me. I think it lacks any quality, really. I appreciate you making some value arguments for it, but I just wouldn't go there. I think there are far better companies that are available in the UK compared with ITV.
I think if someone had it, though, I wouldn't think it was the stupidest idea.
No.
I think it's just opportunity cost.
Yeah, it lacks any appeal for me.
Yeah, right. Shall we move on to a business that possibly does have some appeal for you?
Well, it's certainly a business that's had a big turnaround in the last few years and since we've started covering it. So Rolls-Royce had their full year results out with full year revenue up 16% to £17.8 billion, which was ahead of market expectations. Performance was helped by double-digit growth across its 3 core divisions. Underlying operating profit jumped 55% to £2.5 billion, and profitability increased across all divisions, with a particularly strong uplift in the civil aerospace, reflecting an improved aftermarket performance. Free cash flow nearly doubled to £2.4 billion, driven by the uplift in profits, and there was a net cash position of around £500 million at the year end, compared with a net debt position of £2 billion last year. Full-year dividend of 6 pence per share was announced, and a £1 billion share buyback programme is set to begin immediately and complete in 2025. In 2025, underlying operating profits and free cash flow are both expected to land between 2.7 and 2.9 billion. Mid-term, so around 2028, guidance has been upgraded, with underlying operating profit and free cash flow expected to reach between 3.6 and 3.9 billion pounds and 4.2 and 4.5 billion respectively. Both measures were ahead of market expectations, and the shares were up nearly 15% in early trading. In terms of valuation, the group has a market cap of £66.8 billion and trades at just under 29 times forward earnings, compared with a 10-year average of 16, and it has a prospective dividend yield of 1.1%. I thought these results were really excellent. The group, I think one thing that we haven't traditionally liked about it, which is still there, is that this sort of huge capital expenditure. But equally, you see that and then producing these results. It's an industry that has very high barriers to entry, obviously very highly specialised, and there is that growth trend at the moment, particularly with defence. And it does seem to be much better run now. I think they have trimmed a lot of fat from this business, and there have been layoffs and contract renegotiations, but this all does seem to have turned it round. So I thought, yeah, excellent set of results. I think ultimately it's not an industry that I would particularly like to be in for some of those reasons of the capital intensity of it, but these results are fantastic. Sam, what are your thoughts on the results and Rolls-Royce as an investment?
I think it's a fantastic set of results. There's not really anything in there that you can criticise at all, and that's been the case for a while now. It's now up pretty much 4x from where it was during the COVID lows. I think it's up more than that, actually. I think it might be up like 7 or 8x from the absolute lows, but I wouldn't have expected this kind of turnaround. And it doesn't, I know they've trimmed a lot of fat and stuff. I suppose they've benefited from the increase in defence spending from a lot of countries. But yeah, it's just, I think management's done an unbelievable job turning this around, because it looked like a company that was potentially down and out 4 or 5 years ago. And yeah, now I think it must be the best performing stock on the FTSE the last few years. I think just struggled to find one that's done better, and it's never been attractive for me for the same reason as you. I just wouldn't want exposure to the industry, but incredible performance, really. Do you question who'd want it at this valuation? And I think it's a similar issue to when we covered BAE a few weeks ago, where you've got so much of the increase in defence spending already priced in that. And it's probably still quite a cyclical business, that I don't know who is paying 29 times earnings for a 1% yield from this. I suppose if operating profit increases 55% a year for a few more years, that will soon come down, but I wouldn't be comfortable paying current levels.
Yeah, and for reference, in terms of the share price, compared with pre-COVID, it's up nearly immediately pre-COVID, it's up nearly 2.5 times. And then if you looked at it, just over the last couple of years, so sort of 3 years, it's a 10-bagger.
I think the time to buy it was probably 3 years ago.
Yeah, fine. Shall we move on to Ibstock?
Yes. So it's a company that I used to own. So it's the UK's largest brick maker, for anyone that's not familiar with them, but they've come out with their full year results, and full year revenue fell 10% to 366 million, which reflects lower sales volumes, particularly in the first half. Underlying cash profit fell 26%, 79 million, impacted by lower revenue and the non-repeat of 15 million of one-off inventory benefits the prior year. Underlying free cash flow improved from an outflow of 16 million to an inflow of 11 million, largely due to lower capital expenditure. Net debt rose 21% to 122 million at the year end. Trading for the first few weeks of 2025 has been solid, with volumes ahead of the prior year, and Ibstock expects to make good progress in 2025, with performance weighted towards the second half. Final dividend of 2.5p was announced, taking the full year total to 7p, and the shares rose 4.2% following the announcement of the results. In terms of valuation, the business trades at a forward PE of 14.7, and that compares to a 10-year average of 12.8. And the prospective dividend yield for the next 12 months is 3.5%, and that compares to a 10-year average of 4.4. I think these results are quite disappointing. I think given the year we've seen from the house builders, it's not a surprise, but they're now starting to pick up more, especially when you look at the order book. So I'd expect Ibstock's probably going to have a similar thing. But if you look at the business over the past 10 years, revenue's actually decreased by 1.2% per year on average. I suppose it's slightly skewed in that if you take out this year with the 10% drop, it's basically flat instead. But it's not really, I know it's the biggest by capacity, but it's not really growing. And I think if you look at a lot of the house builders' results over the past 10 years, the revenue would be a lot better. So I'd always considered it quite maybe a bit of a safer play on the house building market. But again, operating profit's been decreasing, the margins have been getting worse. It doesn't seem that cheap. I think you can get house builders, maybe they're going to be a bit more volatile, but you can get them at probably a similar PE, but with a higher dividend yield. I think since we started covering it on the show, it's not really grown at all. You'd expect sort of long-term tailwinds from the situation with house building in the UK, but I think if you wanted that at this point, probably just go out and buy a house builder because they're now much higher, as we sort of mentioned every couple of weeks. They are much higher quality than they were in, say, 2008. So yeah, I think it's quite disappointing actually, and I know it's in line with the house builders, but I just think when you look further out, it's not really tracked performance of them in the way you would expect. What about you, John?
Yeah, I would largely echo that. I do own a house builder. I'd be less interested in Ibstock. I think if you were being a bit more bullish about it, you would say, hopefully, as interest rates continue to fall and all of the structural imbalance between demand for homes and that we need to be building a lot more in the UK, that Ibstock as a domestic brick maker and with the nature of bricks and that you're not wanting to sort of ship them across the ocean to the UK, it should benefit from that trend, but it hasn't quite come through yet. Hopefully it will do, in the longer term for Ibstock, but it's been a bit of a difficult time. And yeah, I'd probably personally just be sticking with a house builder.
I think my main issue is that, although I agree with your argument, I think you could have made the same argument 10 years ago. And then you look at it and nothing's happened. And if you look at the house builders, that's not the case.
Yeah. I don't know when it was with Ibstock. I think it was bought by a private equity group, a US private equity group. And then I think it was spat out maybe about 10 years ago. And over that time, it hasn't really performed.
Private equity probably got out at the right time.
Well, yeah, that's right. And that was probably, with Help to Buy and things at that kind of peak point in terms of valuations. So yeah, they probably did time the market quite well there.
Right, shall we move on to LSE Group? I don't think we've done this for a while.
No, we haven't. And I know a lot of people, like the London Stock Exchange Group, they had their full year results out a couple of weeks ago with reported 7.7% organic growth for the full year, ignoring currency moves to £8.5 billion. Growth was broad-based, with the data analytics business securing an annual subscription value growth of 6.3%. Underlying operating profit rose by 9% to £3.2 billion, and that's compared with a £3.1 billion expected, outpacing revenue growth as margins improved. Free cash flow rose from 1.6 to 2.2 billion pounds, and net debt rose from 6.1 to 6.5 billion pounds, driven by acquisitions. And £1 billion was returned to shareholders via buybacks in 2024, with a further 500 million to be completed by July. A dividend of 89 pence per share was also announced. For 2025, full year income is expected to rise between 6.5% and 7.5%, with free cash flow of at least £2.4 billion. And the shares were up nearly 3.5% in early trading. In terms of valuation, the group has a market cap of £58 billion and trades at 27 times forward earnings, compared with a 10-year average of 25, and it has a prospective dividend yield of 1.3%. I thought this was a decent set of results. Interesting move into data analytics with the acquisition of Refinitiv in 2021, which is where most of the revenue is coming from for the tools and services in the financial industry, alongside their traditional revenue streams. And interestingly, they mentioned in the results that they have partnered with Microsoft to integrate some of those analytical tools into Excel and Teams. I think all that being said, though, it has been disappointing in terms of the lack of listings in the UK and some of the big companies like BHP and Arm moving away in recent years. And then more recently, Unilever not choosing to list their spin-off of the ice cream business in the UK. It's certainly not a cheap business. I think there probably are some very high quality elements to it, though. I suppose in future years, there may be some benefits if there is more deregulation in the UK in the context of, sort of, like I said, Brexit Britain, and whether they're able to make use of that and attract more companies to list in the UK. I suppose one of those big controversial topics at the moment is whether Shein is going to list in the UK and whether that will be permitted. But that would be a big boom for the LSE, certainly. I think they talk about a market cap of potentially 50, 60 billion pounds. So big company, but I suppose it's got that sort of political element to it too. But that's a potential win for the group. So in summary, I don't think I'd probably be buying shares. And as I say, it's certainly not cheap, but I think there are very high quality elements to this business. Sam, what are your thoughts on these results and London Stock Exchange Group?
I think the results are pretty good. I think the organic revenue growth of 7.7%, I think that's pretty good. Operating profit up 9%. I just think, again, when you look at it over 10 years, so the revenue's actually gone up at an average rate of 22% a year. Operating profit's gone up on average 14.2% a year. But that is mainly driven by acquisitions, so it's kind of distorting the figures a bit. And then I think that's shown because they're obviously having to pay off the interest. But the earnings per share is only up in 10 years, 7.6% a year, which is pretty good, but it's nowhere near the revenue. And then if you look at it again from sort of 2021, 2022, the earnings per share hasn't really changed much. So the Refinitiv acquisition, although it's added quite nicely to revenue, it's not flowing through into earnings. I think that, how much is the debt compared to the operating profit? It's not too bad. Net debt's about twice operating profit. I think it's a high quality business, but most of the growth is driven by acquisitions. I think that 8% organic growth is good. It would be nice to see them sustain that. It's a business I think I'd potentially be interested in given the quality, but one issue I've got is I struggle to tell how saturated it is, and can they actually keep increasing revenue organically 8% a year? Because they're sort of so dominant in their market, I do kind of struggle with assessing how saturated it is. But I wouldn't really be comfortable paying 27 times earnings for it with such a low prospective dividend yield, especially when in the last few years, the earnings haven't actually really changed that much, even though the revenue's gone up. So I think it's a business that is definitely not going on the watch list. It's a business I'd potentially be interested in at a different price, but that price I think would have to be quite different from where it is now. What about you? Would you have it on the watch list, or is it not there yet?
I don't think it's quite there yet, but it's an interesting one to follow, certainly.
Yeah, and I think in terms of the quality, it's got the potential to be a watch list stock at the right price.
Yeah.
Whereas ITV probably have to drop to about 2 times earnings.
Yeah, that's right. Okay, right. On to Sea Limited then.
Yes, so it's a company we covered a few years ago. I think it was around the height of the pandemic. So Sea Limited, for anyone who's not familiar, they are essentially the Amazon of Southeast Asia. That's probably what C stands for, actually, thinking about it. So, yeah, they're the Amazon of Southeast Asia. They've also got like a gaming division for mobile gaming. They've got a few other bits as well. They've got like financial services, so kind of like the PayPal. Anyway, we've not covered them since I think they were trading at about 17 times revenues or something like that. So they have come out with their full year results for 2024. And total GAAP revenue was up 28.8% to $16.8 billion, and all these figures are in dollars. Gross profit was up 23.5%, $7.2 billion. Net income was up from 162 to 447 million. Adjusted EBITDA was 2 billion compared to 1.2 billion in the prior year. And that's for the group as a whole. For the e-commerce division, gross orders totaled 10.9 billion, up 33%. Gross merchandise volume was up 28% to 100 billion. The GAAP revenue was up 37.9% to 12.4 billion. And that included marketplace revenue, which was up 37.8% year over year. Adjusted EBITDA was up from negative 213 million to positive 155 million. For the financial services, GAAP revenue was up 34.6% to 2.4 billion. Adjusted EBITDA was up 29.5%, 712 million. For digital entertainment, bookings were up 18.7% to 2.1 billion. GAAP revenue was down from 2.2 to 1.9 billion. Adjusted EBITDA was up 30.2% to 1.2 billion, and adjusted EBITDA represented 55.8% of bookings for the full year compared to 50.9% in 2023. So one of the things that had been driving a lot of the valuation previously was they had a game called Free Fire. It was a battle royale game, and that was huge. That seems to have dropped off a bit. So in 2021, that had a peak of 150 million daily active users. By February 2024, that declined to 100 million, and it's probably even lower. In revenue, 2021, Free Fire was generating approximately 1.2 billion in revenue, and that dropped to 500 million in 2022. In 2024, it stabilized at around 408 million. But I don't think they've really come out of a game that's had that same appeal as Free Fire. So that being said, for the past 5 years overall, revenue's compounded at nearly 40% a year, gross profit at 52%, operating profit you can't do because they were negative for a few years, but they're now starting to churn out operating profits and net income. Yeah, my conclusion is that I think these are an excellent set of results. It seems like the company's kind of just carried on plugging away since we last covered it. In terms of the valuation, though, that has come down a fair bit. So price to sales is now 4.26. Price to gross profit is now 10. It now has a PE ratio, but it's 173, so not that useful. But in terms of the price to free cash flow, that's now 32. I actually think if it was able to sustain these kind of results, 32 is pretty reasonable. It doesn't need that many years before that comes down quite quickly. My issue would be, I think one of the things that's really driven Amazon, which it is going to be compared to a lot, is the data centers, the cloud. There's nothing in those results that suggests it really has that as much, which is a bit of an issue because that's what's driven a lot of the Amazon performance. So if you're left with just a marketplace, I appreciate they've also got what is the Asian PayPal element as well, and the Asian, I don't know what you'd call it, equivalent of some mobile gaming platform, but I don't think they're quite as good. So it's easy to look at it and say, well, if it can keep, even if it can keep growing at 40% a year, I think because, especially with the marketplace, I do have questions over what the margins are going to be in the end. I think for the PayPal one, they'll probably be quite good. But again, we've seen similarly, I know I'm a PayPal shareholder, but we've seen similarly with PayPal, there is a lot more competition in that market than there used to be. I think we've seen with the gaming side of the business, with Free Fire, that's kind of dropped off and we've not really had anything that's come out and replaced it. So I think if you're paying 32 times free cash flow, yes, you can make an argument for it, but I'd be concerned there wasn't enough quality there to justify paying that kind of price. But, you know, if it can hit these kind of figures again for another year or two, it's come right down. But for me, I'd probably want to see it a bit cheaper still to consider it, just because there's so many question marks over different parts of the business, despite the fact the figures it's putting up are excellent. What about you, John?
Yeah, no, I would agree with you there. I think it's interesting in terms of the fintech side of it and see money, because that is it's a bit like when we cover Airtel Africa, in the sense that there is quite low banking penetration, and see money is clearly taking advantage of that. However, it's something that is very, very competitive market. And it's the same with the Shopee part of the business as well, with the e-commerce. They are the market leader at the moment, but again, highly, highly competitive. And you've touched on all the points when it comes to the gaming side of things. It's probably a bit risky for me, but I appreciate at that valuation, if they continue to put up the numbers, it does look much more reasonable. But I think the risk versus those question marks is a little bit great for me at the moment.
Possibly worth mentioning as well, it's down significantly, probably since we last covered it. I can't remember the exact price, but it peaked during COVID at about $370 a share. It's now at $127. A couple of years ago, it did actually drop as low to about 40. So
yeah,
probably up about 3x from the bottom. I suspect at 40, it wasn't putting up these kind of figures. And I think that's probably around the time that Free Fire was maybe declining the most. So I don't think we did cover it around then, but I think if we had, I don't think it would have necessarily been a screaming buy, because I think there probably was a lot of risk. It's then going to have to go and stabilize. But it does kind of show just how quickly sentiment change on this business. And the other thing is, I know compared to like businesses like Amazon and Nvidia, it's not huge anymore, but it's still got a market cap of 73 billion.
Yeah.
And I think at 32 times free cash flow for a business of that size, it's got to do quite a lot to justify the current valuation. So I think although you can make an argument for it, for me, I wouldn't want to pay that much, especially for a business that I struggle to understand. It's not like I can see and use the product because it's in Asia.
Yeah, no, absolutely. Absolutely. Of the companies this week, what would be your top pick and what would be last?
It's quite tough this week. I think I'd probably put Tritax top, but in terms of actually going in my portfolio, I'd want to see a slightly better valuation. But I think with everything in the round, I think it's probably the most attractive of the 6 this week. Least favourite, I think it's a bit harsh because the results are excellent. I think my least favourite would probably be Rolls-Royce, but that's mainly just because I think when you look at everything in the round, at that valuation, it's probably the one I would be the most uncomfortable holding. Whereas I think ITV is a worse business, but it's cheap enough that although I wouldn't love it in my portfolio, I'd feel a bit better than Rolls-Royce at 28 times earnings or whatever it's at. What about you?
I would go for Tritax, and I'd be quite comfortable holding that in my portfolio. In terms of what I'd like the least, probably be ITV, actually.
Fair enough. I think that's everything in that case.
Thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.